Alright, ladies and gentlemen, this is a quite important update for the Dow Jones Industrial Average. Please don't make a mistake and rush the market now. First of all, we are at 19,756 points. That's approximately 200 points or only 1% from 20,000. The 20,000 level, do you think it will become it will go beyond it very easily? No way. Just like the 10,000 level, this is a massive psychological resistance barrier, and you cannot get so easily past it. You cannot simply overrun it like 18,000, 19,000. At 20,000, a lot of people that are very big, that have very big gains since 2009 will say, very nice gains, that's a round number, we will take the gains and get out. And a lot of short sellers will try this round number to sell. Also, if you look at the very long-term 10-year chart, you see the RSI from 2013 to 2015 was above 70, but since then it was below 70 and now it has reached 69. So a weakening RSI, at least until it breaks out above the 2013-2014 highs. At the moment we have a negative divergence here. Although Dow Jones Industrial Average has risen higher than it was in 2013 and 2014, the RSI has not made new highs. The slow stochastic is also below its 2013-2014 highs. Yes, and look at the MACD. Look at this MACD. It is also clearly, very clearly below its 2014 high in the 10-year chart. So negative divergence here until it goes much higher and these negative divergences are overrun. But I don't think so, because also the 20,000 dollar level, that's a psychological number, that's a huge psychological number, just like 10,000. This will be a very hard fought level. The bulls and bears will fight a lot at this level. The bulls won't simply overrun it like they did with 18,000-19,000. Maybe they will get a little bit above 20,000, but then there will be attacks from the bears, pullbacks. Especially because if we look at the 1-year chart, we are quite oversold. The RSI above the 70 line, slow stochastic also oversold, going sideways in oversold territory. Stochastic RSI also oversold for a longer time. A pullback is more likely than a continuation of this rally, especially if we arrive at a huge psychological number like 20,000 at these overbought conditions. And don't forget, the 10-year Treasury bond interest rates are rising. Rising interest rates aren't that good for the stock market. Sooner or later, rising interest rates will affect the companies who have to pay higher interest rates on their debt, and that reduces the income, the earnings of these companies, and that affects the stock price to the downside, downward pressure. And yes, I don't have to tell you that interest rates in the 10-year treasury notes have been risen from 1.7 to approximately 2.4 percentage points. So be careful. Don't enter this market at 20,000. That's not a very wise thing to do. Can it go higher? Of course it can, but the probabilities are getting less and less likely. Three-month chart. We are even above the Bollinger Bands. The RSI 84 even more oversold in the 3-month chart. Slow stochastic also oversold. Everything's oversold here, and what I would like finally to say, this rally since 2009 has gone a long time. Yes, and these little corrections here and here, they have been corrections within the uptrend, no bear market. So we had a bull market since 2009. 1, 2, 3, 4, 5, 6, 7, almost 8-year bull market. I do not think this can go on forever, especially because now, since a few months, interest rates have begun rising. Okay, they haven't risen so much, but I think they will keep on rising in the coming months and years, and that will put a huge downward pressure onto the stock market. So I do not think that this rally will go on much longer. Most of it, yes, I compare it to 1999, 2000. Either this rally will end at the end of this year, or in February, March 2017. April, May. Sell in May and go away. And at the end of a long bull market, often there's a final blow off top. A big, fast, furious rally, just like in the year 2000. And then it falls apart. It drops like a stone and a new bear market begins. In the 1-year chart, you can see that in the last month we had quite a big rally from 18,000 to now 20,000. That is 2,000 points. Yes, 2,000 points. Although interest rates are already rising. Of course, a lot of people have gone out of bonds. That has helped the stock market, because bonds are more vulnerable to rising interest rates than the stock market. So bonds fall first if the interest rates are rising, and money moves from bonds to stocks. But if this trend continues and interest rates keep on rising and rising and rising, also the stock market will be affected, and it will also drop and not rise anymore. And the money, where will the money go? Yes, back into bonds, because there you get, or into bank accounts, because if interest rates are rising, yes, get more interest. From the bonds, if you buy them, and less dividends from the stock market. No technical signs of any weakness until now. Only we are outside the Bollinger Bands. In the 1 year chart, 19,400 is the upper line of the Bollinger Bands. We are 368 points above the upper line of the Bollinger Bands. That says we are clearly overbought. Also at RSI slow stochastic, and this slow stochastic has now reached its trigger line, and now it could very fast, very shortly cross it to the downside. And what really concerns me, this 20,000 level. 20,000, that is a huge round number, a big psychological barrier. You won't overcome it that easily, like 18, 19, 17,000. Under absolutely no circumstances would I go into this market. And at these overbought conditions now, if this market would rise above 20,000, 20,100, 20,200, I don't think it can keep this level. I would go short big time. I would go short big time. I would already now go short big time, because this is not sustainable. Especially because interest rates will keep on rising in the coming years. Because so much debt has been created by the central banks, and this debt will now, as interest rates begin rising, finally, yes, be spent so that it is spent into real assets, so that when interest rates and inflation are rising, this huge amount of central bank money must be invested somewhere where it can, yes, where it is safe from rising inflation. And that is not in the banks, in the bank accounts, because I think the inflation will rise faster than the interest rates, because so much money has been created by the central banks. And once this money goes out of the bank accounts into the real economy, this will cause huge inflation. And the moment is now, I think, that this is beginning, because interest rates are rising. That's a sign for the clever investors. Take the money out of the bank accounts and into real assets, into the real economy. That will cause big inflation. That will cause interest rates to rise even higher and higher, like in the 1970s. And finally, stocks will drop fast and crash. Yes, crash. If interest rates go up to 4-5 percentage points, stock market will go down to 10,000 again, I'm sure, or lower. So this 20,000 in the dough. No. Not sustainable. What I expect in the next months, I expect money to go out of stock market into the bonds again, because interest rates and inflation will rise even higher from here on, and rising interest rates are bad for the stock market. Okay, rising inflation is bad for the bond market, but I think in the next 2 to 3 months inflation will not rise much faster than interest rates. So money will go back into the bond market, but then in the next 3 to 6 months inflation will start rising very big, much faster than the interest rates, and that will cause money to go out of the bond market, but not into the stock market, but into the precious metals, because precious metals love huge runaway inflation. That's what I see coming in the middle of next year. Huge runaway inflation that rises much faster than the interest rates. So in the middle of next year, both stock market and bonds will lose much money and drop fast, and money will finally go into precious metals and other, yes, hard assets like copper, or maybe even art or diamonds or whatever, but not real estate, because real estate will also drop because of the home loans that will also be under pressure because of rising interest rates. The mortgage market will suffer big time from rising interest rates, especially the non-fixed mortgage market. Okay, enough of this Dow Jones Industrial Average. It has risen higher than I thought it could, but I'm sure we are very close to the limit, to the wall, to the ceiling. A very good time to go short. Okay, let's go to the silver market. Instead of gold, silver has not made a new low in December. The low was made in November. So the low seems to be holding in silver, $16.20. We have been going up a little tiny bit. Not much. But I think this uptrend, like I often already said, will continue higher from here on, because slow stochastic has given a buy signal, and it is at 13 in the 1 year chart. That is very, very low. That is very oversold. Huge upside potential. RSI 43 in the 1 year chart. That's also very low. Much upside potential. Look at the MACD. MACD 0.25, so below the zero line, but the bars are getting a little bit smaller and the low is holding. Also, gold has made a new low in December, silver has not. Silver in a trend of direction, silver must be the leader in most of the times, so this time it looks also that silver is leading to a new uptrend, from this downtrend to a new uptrend, and I think gold will follow. The gold stocks have also not made new lows, only the price of gold has made a new low in December. But look at the RSI now, 33, very much oversold. Slow stochastic at 5, that's ridiculous low. And that's really low. Yes, very. This is ridiculous low, and the slow in the gold market, and the slow stochastic has met its trigger line and is very close from crossing it to the upside. MACD also big oversold. We are so oversold here. A counter trend rally is so likely now. And silver has not made new lows in December compared to November like gold did. That's a positive divergence. Also, the gold and silver mining stocks did not make a new low in December compared to November like gold did, so that's also a positive divergence. I think we are very close to the bottom. I would say the bottom is in, and from here on we will go up at least 100 points, maybe. So at this point, gold and silver are clear buys, and the stock market is a clear sell. This is so obvious to me from the technical indicators and from the perspective of rising interest rates in the next months and years. Not because interest rates are rising, that wouldn't be that good for gold, but because inflation will be rising much faster than the interest rates. So the real interest rates will still be negative and getting more and more negative in the coming years. So, but yes, at this moment, get out of stocks and get into gold and silver. And you can also get into the bond market. But the bond market is only a short-term trade. 1 to 3 months, not much longer. Whereas the gold and silver market, I think, will go on for a few more years. To, you know, in Elliott wave count, we had a 1 from end of 2015 to the middle of 2016, and a 1 up wave and a 2 correction down wave, and now we are getting a 3 wave up. A third wave is the most powerful in Elliott wave, and so expect big gains in gold price in the short time frame. Expect a golden year 2017. Expect much higher silver prices in 2017. Expect higher bond prices at the beginning of 2017, but after that bond prices will continue falling. Expect much higher interest rates and inflation in 2017. Expect much lower stock market prices in 2017. I'm sure the foreign managers and the big banks will try to keep up the stock market until until end of December, so that they can make much money from provisions. Yes, the higher the stock market is, the more money they get at the end of the year, because that is in their contracts. But so they will probably keep up the stock market this year, but next year, especially after spring, the summer and autumn will be terrible for the stock market. It will only go down and down and down and down. And I have no doubt about it that technical indicators are telling me this. We are much too overbought, the rally has gone for much too long, and now because of interest rates are rising again, inflation is rising again, first slowly, but the trend change has occurred, and in the not too distant future, much faster and much higher. Say goodbye to the stock market bull. Say hello to the stock market bear next year. And keep on buying gold and silver stocks and gold and silver coins, and not nonsense like exchange rate force ETFs or gold and silver derivatives. That is nonsense. If you have counterparty risk, you have a counterpart risk, and that's not worth it. Yes, Yeah, as I said, I think they will try to keep up the stock market until the beginning of next year, so that the big banks and foreign managers can get extra bonus payments, but so don't expect big correction this year. Possible, but not so likely. But expect huge stock market drop next year. And I will continue covering these markets, and I'm sure I will see what I expect to see. Goodbye for now. And once again, because I cannot say it often enough, buying gold and silver at this moment is such a great chance risk relationship. So much chance, so little risk. Quite the opposite in the stock market. So much risk, so little chance. Yeah. Market decisions have never been so easy, in my opinion, than they are at this very moment. Especially for the last time I mention it in an area of rising interest rates, which have begun rising since 3 months ago and will keep on rising for a very long time. Goodbye for now. Good luck.